Hello, Jim here. I recently had my best week of trading. I want to talk about that week, why it was special. I want to share with you the 8 trades that I did make and why they worked out so well. I'm also going to kind of talk about what's going on in the economy and what I think might be coming next. So stay tuned. I think you're going to really enjoy what I have for you. Okay, let's jump right in. I do like to give a quick market update. We keep hitting new highs in pretty much all the markets. The employment report that came out today, again, was showing that employment is up. And I believe we had some reports last week that showed inflation was also up. So my guess is we're probably going to get a quarter point cut in November. At least that's what I'm thinking right now. Or maybe they won't do any kind of cut. It's just kind of a mixed picture. I don't know if they're propping things up because of the election coming up so soon. I wouldn't be surprised because I know recently they've readjusted a lot of the reports, especially employment reports, upwards, meaning they've showed a lot more people were unemployed than what the original report showed. So I don't know. What I can advise is still consider the market is very, very high. I believe there's a pretty big greed factor out there. So what can you learn from this is, again, just to stay safe. Don't be putting on crazy trades or taking too much risk. At least that's what I'm trying to do. But I'm also not getting out of the market. I'm not avoiding trading. I'm continuing to trade and still make some really good income from trading, as you'll see at the end of this video. So like I mentioned in all my videos, it comes down to really good companies. I like companies that have low debt, yet typically below 50%, like a 50 debt to equity ratio. I really, really like companies that have no debt. I like companies that have good profitability, return on equity, hopefully above 20, 25, return on assets like in the teens, and then, good income coming in or good cash flow coming in. I also like to see year-over-year earnings growth. Plus, I like to see companies that are growing. And I typically don't invest in companies that don't make money. I do get a lot of questions from people, what do you think about this company or that company? And one of the first things I look at are they currently making money? Because I don't typically trade in any company that doesn't make money. And price does matter. So once I find really good companies, a lot of times I will add them to my watch lists. But I won't necessarily invest in them. I next look to see, are they at a good price? And how do I do that? I like to look at PE, price to earnings. I like to compare it to the sector. I use Seeking Alpha to do that a lot of times to see if the PE is kind of way up there. If the PE is within, kind of a normal range for the sector, then I'm more likely to invest in that company. But there are a lot of companies that have really high PEs that their performance and their business doesn't really warrant such a high PE. So, again, it is important. Price is important, and it will have an impact. At some point, we will get a correction. And just like we have this huge momentum and people are being greedy, you're going to have a lot of fear when that happens. And at that point, if you've invested in good companies at a good price, you're going to be perfectly fine. The worst thing you can do if we have a major correction is get out of the market. And I know of a lot of people who've come into my membership that's just what they did after 2008 and 2009. I have a lot of people who are in their 50s, 60s, and 70s. So a lot of them experienced that, and it scared them enough that they never got back in the market. So they missed one of the longest, best bull markets out there. And then I'm a trader I'm actually an investor before a trader. So I use trading options as primarily extra icing on the cake. I don't trade just to trade. And I do have a lot of members in my memberships that their preference is just trading. They don't necessarily want to own these companies. It's a little bit different for me. And I like to use safe strategies, in order to pick up the income related to trading options. So I like to stick with strategies that I understand. that I feel are fairly safe. You know, they're cash secured puts or vertical put credit spreads or covered calls. I don't do a lot of what's called naked type of trades where I don't have enough income to actually buy those shares, and maybe, you know, you would use margin. I don't typically use margin, and I don't take a lot of risk. To me, we'll be 59 soon, and you know, in 59 and a half, I can start accessing my retirement, my IRA, and my Roth accounts. You know, so I don't have a lot of time. If I make a huge mistake and I blow up my account, I don't have 10, 15, 20 years to, you know, fix whatever mistakes I might make. So I'm more of a safe type of trader. Plus, I don't do a whole lot of trades each day. As you'll again see at the end of the video, I typically do 1 to 2 trades a day. Some days I don't do any. Some days I'll do 3 or 4. And I have a real kind of basic way I do it because, you know, I don't have a lot of time. I'm still working. I'm helping my son start his own business. And we're actually building what's called the barndominium. We bought 6 acres of land, and we're going to kind of move into the countryside. And his business will be run from that barndominium. So that's also keeping me very busy. And then I really do like to manage the trades. I typically will, at 21 days, like 21 DTE or about 3 weeks, I will start managing, you know, looking at them. I don't ignore the other trades, but, you know, if they're deep in the money, then I might make a trade early. But typically that 21 DTE seems to work out well. A lot of times it's a really good point to be able to roll or to close a position because they become very profitable. I'm a little bit unusual because I will typically hold on to, I want it to be very profitable before I close it. So a lot of times, you know, my positions are 85, 90, 95% profitable when I close them. A lot of my positions I close for, you know, right around $20 or a little bit less. Sometimes in the teens, I've closed some for like $10 or $12. But managing them at that point, looking to see, well, can I roll it? Can I, you know, should I close it? And at times, you know, you might be able to do both, but you might choose, well, I'll close it because the stock's up today. And then when it has a down day, then I'll open up a new position. That's really rolling. Rolling is just closing a current position and making enough to open a new one and pay for closing the previous one. So you can have a time break between that. You don't necessarily have to do it all in one trade. So, and that's made a big difference for me. One thing it is important to become a better trader is closing your positions more often. So I have about 80 positions open at any time. So if I do 5 new trades, I'm looking to close 5 trades. I'm trying to keep it fairly balanced and stay pretty close to that 80 open positions at any one time. So that all being said, I just will touch on a lot of this in a little bit more detail when we go over the trades themselves and what I learned from the trades for this week. So stay tuned. This next section will be well worth your while. Okay, what I've done is I've opened up my spreadsheet. I just made a copy with just the trades from last week. It was actually last week that was such a good week. I made literally $3,466, and I'm just going to run through the trades. They were a pretty good mix. So the first one was Google. I actually did a roll of a covered call. I had a 180. This was related to what I was calling my shielded wheel trade. So I bought 100 shares of Google. I sold a vertical put credit spread, and I sold a covered call, and it's worked out really well. I need to probably look at doing more trades. So the current price at that time was 191. Now Google has come down, but I rolled it, kept it at the same strike, rolled it from 1220 to 321, and I brought in $451. At that point, Google had some really good premium, and it was like a 6% return because it was going out nearly 6 months. I believe the DTEs were 165 days plus, you know, Google at, you know, is right around 18,000. So the required capital was 16,433. So that's why, you know, the 451 divided by the 16,433 adjusted for the year is why it came out up to be 6%. But even though it's such a low yearly return, it's still a lot of cash to bring in, 451. Next is IJR. This is the only ETF. It's one of my favorite ETFs. I believe it's related to the S&P 600, and I believe it primarily holds companies that are a little bit bigger and healthier. It might actually be I think it's the 600, whereas the Russell 2000, so it's like taking that cream of the crop, the top 600 from the 2000 similar companies within the Russell 2000, and then putting them into an ETF. It does pay an okay dividend too, but it's been one of my favorites. I own quite a bit of IJR, and it's done quite well over the years. So I sold a covered call. It was at 110. It was expiring 117.25. It was 106 at the time, and I rolled it out to 115.26. So literally this was a leap. I rolled it out an entire year, brought it up to 115, and I made over $760 on that one trade. You might consider, well, why would you do that? It was just a really good day, and I believe that price I had at 106.66 was incorrect. I believe it was slightly in the money, like 111, and I wanted to get it up to 115 and get it out of the money. Capital required was 1788.88, and this was like a 3% because, again, I went out literally 466 days. And what I find is when you do leaps, when the market does correct, and I do believe the market is going to have a correction at some point. It's not a matter if, it's more of a matter when. The value, if IJR drops, into the 90s, it'll become very profitable, and I can literally close it or roll it back. And I've done that quite a bit. I do that with Coca-Cola a lot. So the next trade is Tesla, and I actually had this at one point. I was really worried about Tesla, and I was trading in it when Tesla was back in the mid 100s. Now it's a lot more expensive. It is coming down again, but I closed a cash secured put, and because I had so much capital tied up, but I paid only $7. Another example of closing a position fairly cheap. I could have rolled it, but I like Tesla, but I'm not really an EV person. Now, they are kind of turning into a software company, but I don't know about their robotic cars. When they actually release or a functioning robot that you might want to own and have functioning in your home, maybe to clean the house, that's something I would really like. I definitely need some help cleaning my house. So being a single guy with a teenage son, not a teenage son, a 21-year-old son, we can be pretty sloppy sometimes. So next is Shopify. This was another good position. I did this on the 8th. It was another roll. It's a covered call, 75. At the time, it was 67, 66. And this was one of the ones that was assigned to me, which was a pretty good loss when it was first assigned to me. But now it's a pretty good profit. It's really gone up quite a bit. So I rolled it all the way up to 85. I rolled it to 919.25. And again, brought in some really good premium, 663.19. And then if you look at the capital required, which was 12,560, and a lot of times I take that right off of the cost basis for the stock. So when I looked at my cost basis for my Shopify shares, that's literally what it was. And then this is like a 6% yearly return. They don't pay a dividend. And I believe they might be like 81 or 82. So it's worked out really well. Next is Dell. This has also been one of my interesting trades. It originally was set up as a vertical put credit spread. I called Fidelity, had them break it apart, and I've been rolling Dell as a cash secured put and making a lot of money with it. It's 2 contracts. This I did on the 9th, cash secured put 105, which is, I believe they're currently at 130, and I'm still getting some pretty good premium that cheap. At the time, it was 113. I believe they're closer to 130 now. And I rolled it out to 12, 20, 24. And I kept the same strike. I could have gone lower, but the 105 was really very low delta. Not very risky. but I still brought in some pretty good premium, 451. And then the being that it's a cash secured put, the required capital is higher, so it's 21,000 minus what I brought in from the premium, which is like an 11% return, which isn't bad for a cash secured put. Plus, it's not my first trade I've done with them. I've made over 2,076 in income just trading Dell recently. And then Williams-Sonoma, another company I really like, no debt, very high profitability, almost this, I believe it's over 60 or 70 in ROE. Just a very good company. It did get really pricey at one time. It's coming down now, but its earnings have been growing so much that its PE is still relatively, I think it's like 15 or 16. So just overall a good company. This is a vertical put credit spread that I rolled. It was expiring on the 18th, which is tomorrow, 140, 130, and I rolled it out to 11/15, so just a month. Actually, that's the earnings date. So it may be the 14th is the earnings. So I might close this before earnings. So, but I kept the same strikes, rolled it to 11/15, brought in another $304, which since I started this trade, which was back on July 15th. So just since July 15th, I've made literally $1,100. This is the required capital, which is the spread times 100 minus the 304.51 is how I came up with 1695.49. And this is like an 187% return. Now, if I can close this early too, this would be even higher because it's 11:15. It's already become very profitable. So I might, if I close it, this may be more like a 250, 300% return. And I did talk about maybe I should have gone down on the strikes, but I decided to keep the cash. Next is a new trade on Broadcom. Now, I had closed a previous trade on Broadcom. It was one of the type of trades that I was talking about. I closed it, and then literally 2 weeks later, I opened a new one. So it's a kind of a delayed roll. I think I closed it right around 10/1, maybe the very end of September. So it's a vertical put credit spread, 155, 145. And it's come down recently with the chip makers, but it's still, I believe, pretty high. I'm pretty far outside from the stock price, so I'm pretty far outside the money. And then I brought in 241. This is the required capital again, 2,000. 2 contracts times 100 minus the 241.26. That's how I come up with 1758. And this is like 102. Yeah, because it's 1129. So I found this is one of the weeklies. I found a pretty good roll. So that worked out pretty well, Broadcom. And I believe this is the second or third trade I've done with Broadcom. Now, next is Square. This is related to the video I did last time. This is a wheel trade. I own 200 shares currently of Square, so I'm just going to run the wheel on this. I made this trade on the 11th, so late last week. 65 is the strike price, and expiring 11/15. So when I say the true wheel, if it goes in the money and gets assigned to me, then I'm going to right away sell a covered call, again, really close to being in the money, but above my cost basis. So what's different for me is I typically want to keep the shares, but in this instance, and I have 3 others, if you watched last week's video or Sunday's video, I'm also doing this with Pinterest, Chewy, and then Twillo. I'm not planning to own any of them. I'm just planning to continually allow assignment to occur, so sell a cash secured put. If it gets assigned, then sell a covered call. Then if that gets assigned, do another cash secured put. I just want to see how that compares, that trying to own the stock and then looking at the appreciation. I talk more about that again in the previous video that I did. So if you want to learn more, look back at that video. So at the time it was 69.54. Now they've gone up. Square's gone up. I believe it's around 74 right now. So, and then with this trade, I brought in $293. Remember, this is only one cash secured put, literally going out 1 month. The required capital is 65. It was a 65 strike, so 6,500 minus the 293.32 is how I came up with around the 6,200. Might even be a little bit lower. No, a little bit higher. I think I just stuck 6,200 in there. But it's like a 49% return when adjusted for the year. And then I compared it to weeklies. I tried to do a weekly, but the weeklies didn't. I ended up finding a lot more premium in the monthlies, and I didn't. And I found that with all the 4 that I looked at. Pinterest, I think, was the exception. It was either Pinterest or Chewy. So I decided I'm only going to do monthlies, which kind of fits with my way of doing things, again, because I'm working and I'm starting this business and building this barn dominium. I just don't have a lot of time, so I have to stick to that 1 or 2 trades. So, I'll be able to manage this easier versus doing weeklies. Weeklies would definitely take up more time. And then the last trade was UPS. This is another one that was assigned to me. Now I'm selling covered calls, and it's become profitable. At one point, it was a pretty good loss. So I rolled it out from 11/15 expiration out to 4/17/25 and upped it from 130 to 135. So I got it out of the money, and I have a little bit of leeway. And with doing that, if it gets, assigned away from me, I've gotten a pretty good, would have a pretty good profit with UPS. And I brought in 307. The required capital is pretty high. Again, this is taking my cost basis minus what income I just brought in. And that's like a 2.5% return, again, because I'm going out 188 days. And I believe it got I think it got up to says 125, but I believe it got even higher. I believe it was pretty deep in the money in that. So that was part of the reason, was just to roll it. So now all these trades added together, again, is 34.66.12, which I think most of my weeks, my previous highest week was like 2,400. So this is definitely my highest week. This is the cost of capital, or the required capital. So it's almost like a 3.44%. So I get a lot of people that ask me, well, what's all your capital? But I have 4 different accounts. I do trades in the 4 different accounts. When you look at it this way, you can kind of get a better gauge of it. Most of my accounts now, even my IRA, are fairly, I'm not 100% invested, but probably my IRA might be 50% invested now between the ETFs and the stocks. And I even have SPY and some other, like Home Depot, I think I have 50 or 60 shares. I'd like to get another 50 so I could start selling covered calls with it. But, when you look at it this way, the monthly return, and that's what I like to tell people, you can earn up to 3%. In this case, I earned a little bit higher, but this is unusual. So when I say up to 3%, you may have months that are 4% on a monthly basis and some that are 1%. And I've seen that too. This week, I'm not doing anywhere near as much as this, but I'm having also a pretty good week. But again, I'm trying not to take a whole lot of risk. So what did I learn here is, again, what I talked about at the very beginning: pick great companies by looking at profitability, debt, income, and growth. And those are some key factors. Some of my biggest mistakes were related to debt. The only other thing I'd probably add into this is management. We've also seen some bad management, like Boeing's going through a rough time, and it's primarily because of their management. So it should be profitability, debt, income, and growth, and management. And price does matter, fair PE, and use Bollinger Bands. So I do like to use the Bollinger Bands, just to see, am I overpaying? It's another gauge to help me make those decisions. I do like Tasty's suggestion of 45 DTE and 21 DTE for management of trades. And that's pretty much what I do. I originally started with 21 days out for management. Now all positions are shown. So in this spreadsheet, which is typically my planning, like I said, I just made a copy and cut out my other positions. I originally would only show the next positions that were expiring the next 3 weeks. Now I'm showing all my positions. And if you want to learn more about my memberships, details will be in the description. They're growing. They're very active. It was actually hard for me to make a video because I was getting so many messages. And a lot of people are sharing their trades now. Actually, because of last week's video, some people are doing something like what I did in my video last week, but doing it with their own flavor, which is really interesting. That way I can compare how I'm doing to how they're doing, and I wouldn't be surprised if they do better. I definitely have some people in my membership that are better traders than I am. So, and that's what I want. I want a healthy community where people share ideas and, it's not outrageously expensive and it's easy to get in and get out. So again, in the description will be more details. The trades represent a healthy mix of strategies. So again, I had cash secured puts, I had the wheel, I had vertical put credit spreads, covered calls. The only thing I didn't have were iron condors, and I'm finding it hard to do an iron condor at this time with the market so high. I'd like to see the market come down maybe 5% or have a bit of a correction. Then I may start doing more iron condors. Still sticking to my goal of 1750 per week, going to even out over the weeks. So even though I had a great week, I don't try to replicate this the other 3 weeks of the month. I'm still, my goal hasn't changed. By the end of the month, I'm hoping to make between 7 and 8. I'm mainly to stay safe. I do believe the market is a kind of a crazy high right now, and that maybe after the election or going into next year, we will have a correction. Like I said before, it's not if, it's just a matter of when. So that's what I wanted to share with you guys. Let me know what you think. Did I miss anything? Do you have any specific questions? Are there any stocks or ETFs that you really like trading with? So as always, thanks for taking the time to watch, and I look forward to seeing you next time.